when you go to any investment course, you're basically taught a variation of mean variance, which was created 50, 60 years ago, well, more, 70. And it's the same in practice. And what you do then is that you say, well, how do I decide how to allocate between different type of assets? And you say how much you expect in terms of return and that kind of risk. And then they tell you, okay, you should put 20% in real estate and 10% on gold and whatever. And the problem is that that has happened in recent years is that for a number of assets now, you need to commit in advance the capital. And so if somebody says, oh, you should put 10% in private equity, it's like, I cannot just put 10% in private equity. I have to commit an amount of money. And then I don't know when they will call this money. It may represent 10% of my portfolio, but it depends what my portfolio will do in terms of evolution, right? So for example, if I have 100 million right now and I'm committing 10 million and they call it in 2-3 years time, if the stock market went very well and my portfolio is worth 200, then my 10 million committed is just 5% of my portfolio. But if the market tanked and went to like 50 million, my portfolio tanked and went to 50 million, then my 10 million now is 20% of my portfolio, and it's probably too much. And so this creates a new type of risk, and there is a need for modeling this issue.
Commitment quantity risk is very costly to the investor, whereas commitment timing risk is not. So what this means is that the investors care very much about what the commitment to wealth ratio is going to be at the time of capital call. They care very much about not knowing what this ratio will be, but they don't care so much about not knowing when capital call will happen. So why do they care so much about the commitment to wealth ratio? The reason is that if this commitment to wealth ratio becomes too large, at the time of capital call, investors basically have the option to either default, but we've seen that default is pretty costly for them, or to transfer that amount and to have a large portion of their portfolio invested in private equity for an unknown period of time.